Okay, class, I'm back with another video. This time covering our learning unit 5, controlling inventory and overhead cost. It is quite long learning unit, but it's not necessarily difficult. And I'm going to try to cover, when you're going through your reading, some of the things that you are going to find. And obviously, I'm going to share my own notes uh, and some of the most important aspects of this learning unit with you. But what you need to understand that this is quite important, a very important chapter for you as an entrepreneur. Um, so if my sound was not okay at the beginning, let me repeat this again. This is quite an important uh, learning unit for you as an entrepreneur, because this asks you uh, um, very important questions on what you need to know as an entrepreneur. And I'm sure all of you at a particular time will need to know to how to price correctly product that you would one day be called um, to manufacture or trade, depending on which kinds of trading industry or industry you are. You will be required to price your material fairly, and pricing something would require you to know exactly what is the cost of it, and that's what it's all about in this chapter. It's about identifying identifying costs of the different items. So inventory valuation is the process of assigning costs to inventory. It is as simple as that. Inventory valuation, inventory valuation is the process of assigning costs to inventory. So you have, for instance, the inventory concept in a trading organization. The inventory will refer to items that has been purchased with the intention of selling them for profits. That's when we talk about the trading, right? Not necessarily the manufacturing. So we are talking about trading organization as opposed to a manufacturing organization. But you will have direct material, you will have work in progress and finished goods. And I've made it quite simple for you to understand that direct material, it's material that has not entered yet the production, or that has not yet been um, that has not entered the production process, right? And so work in progress are materials that enter the production process, or in the production process, or material that is in the production process. You see, so when you look at finished goods, you're looking at goods that have come out of the production process. So we are opposing a trading organization to a manufacturing organization. And when you're looking at a manufacturing organization, this is what you see. You see a classification of current asset into direct material, work in process, and finished good. All right. Inventory piling. The concept of inventory piling refers to gathering or stockpiling the inventory items that a business needs to operate. All right, so the concept of inventory planning refers to gathering or stockpiling the inventory items that the business needs to operate. The purpose of this is to avoid, obviously, a stock out. It is very important that inventory be available when required by a business, right? So when you're avoiding stock out, obviously, it's when a business runs out of materials that to produce goods and cannot meet the demand as a result, right? So other reason of the stock outs are mentioned there could be speculation, and there is a reason why I highlight that part in the notes is that speculation can push a business to anticipate or to expect a shortage of raw materials, and therefore they 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 stock up, but that stock is called speculative stock, right? Because they are predicting a shortage to come. And you will find, obviously, as usual, in many of these learning units, this is quite important to make you understand some of these terms. And I'm just touching one or two or three of these terms to explain them to you, because these terms will now be very important once you understand them to do the actual calculation. If you do not understand what is being said, what it's all about, you will end up not being able properly to do calculation because you are not understanding what exactly is being asked. Things like the type and purposes of inventory. Okay, so what are the types of inventory that you will have? You will have like the normal stock. So the normal stock, this is material that is in the process of production. It is about to enter the production process, or it has just been completed. So whatever we talked about here, direct material, work in progress, finished goods, this is considered normal stock. All right. Buffer stock is different because this is material that form a buffer between the production and the usage, where production is constant. So there is a constant production and we need material to use into that production. But when there is irregular supply of this material, we need a buffer stock. We need a buffer stock because there is irregular supply. We're not too sure. So buffer stock is basically like a security stock because some of the material we obtain them irregularly, especially maybe when you are importing material from overseas or from somewhere else, you see. So it's not readily available that you could order and get them in, you know, in a normal time, in a predictable time. Okay, but now buffer stock is like a type of safety stock, but what you need to remember is that the supply is irregular. It takes place irregularly. But safety stock also, it is similar to buffer stock, yes, but it is more extensive as it is specifically aimed at ensuring that an enterprise can continue with production as usual. All right, so maybe it might just be about a particular item. Okay, we have a specific raw material, and if that specific raw material that is very important to our production, if it's not delivered within the normal time, it's going to impact our production, and that's why we need to have a safety stock, right? Speculative stock, we did mention about this sometimes, and that's why you need to have to know the definition of these things and make a difference, a distinction between buffer stock, safety stock, and speculative stock. All right, because speculative stock is, as we mentioned before, because we are fearing to have a stock out, to run out of materials, you know, but that is due to speculation. We are predicting that because of the war in the war in Ukraine, with the Russians invading Ukraine, we might run out of wheat. So we might run out of wheat. So since we're going to run out of wheat, then maybe we need to have a speculative stock, basically, and keep some surety, right? So stock in transit, overstocking. These overstocking, as you understand, you are stocking beyond the the volume of inventory that you need actually. So it's more than what is justifiable, right? Understocking is below. These are quite simple. So now we go to some formulas. Average stock, opening stock plus closing stock divided by 2. And I want to really you see make you see this because as you can see there, just a second to activate my pen. And as you can see, uh, if you can see there, average stock as it is. Let me just make a little bit bigger for you to see. So the average stock, opening stock plus closing stock divided by 2. Or average stock would be the order size. This is quite important because this particular formula you will find out, you will find it again when we're doing calculations. You will find of average stock, you take the order size divided by 2 plus safety stock. Very important formula to keep in mind. So maximum stock, this is the highest possible volume of stock. All right, so all about the different kind of stocks that we might have. So material cost control. So inventory evaluation, inventory management fits into a greater cost and management accounting framework. And that's where you hear about management accountant. As you progress as an entrepreneur, you need to know the importance of management accountant and their role to the business. So to determine whether or not a business has incurred inventory losses, a stock take needs to be conducted. All right, stock take, especially when we are looking at closing inventory, we are looking at a particular production cycle. We can take at the end of production cycle a cost takes. All right, so all this important. Please have a read and make sure that you understand this. And should you have any issues of understanding particular terms, as you know, you are more than welcome to have a conversation with me. All right. And this is quite important, especially that last sentence I'm calling your attention to. The problem facing the cost accountant is how to determine the value of the direct material inventory on hand at the end of any given trading period. The value of the direct material inventory. So when we are doing the valuing of inventory, in South Africa, there is 2 methods. There is the first in and first out. You will hear about the last in and first out, which is called LIFO, you see, but that is now prohibited and it's no longer used because there's a bit of, it does not really provide important information. But you just gonna concentrate on these 2, and this will be the beginning of your calculations, because first in, first out, and weighted average method, these 2 methods are quite important. First in, first out, obviously whatever came in first is the one that will be used first, and whatever came out last will be used last. So you understand that. So these are method of valuation. Okay, these are method of valuation or valuation methods. Okay, they are not, there will be a difference between these and systems, and you will see that. Okay, so weighted average cost, as usual, you know, the unit price of each unit will be determined by doing the average, right? We are doing an average. Okay, so there is inventory systems, and valuing valuation methods. Valuation method like FIFO, as I call it, first in, first out, and weighted average cost, right? But the inventory system could be either a periodical, or a perpetual inventory system. And these two are different. And that's why when you go to example 5, for instance, they are asking you a perpetual inventory system. So it is important for you to see, we have an example here, a very good example, where data being given to you, as you can see, where purchases, what we are acquiring and what we are selling. The difference between the two, you can see purchases is what we are acquiring as inventory, and issues is basically sales. So if there is a purchase, and you can see there is a purchase of 2,000 units, and it's being sold, 6,000 units is being sold afterward. But when you read the problem, you can see that there were 5,200 units at a selling price of 3 rand each. So these 5,000 on were there on the 1st of April. So always read properly the given of a particular case scenario. So you can see on the first there was 5,200. On the second, 2,000 more were purchased. So 5,200 plus 2,000 more, as you can understand, will give you 7,200. That will make more sense that they can sell on the 8th. They could sell 6,000, because this 6,000 will be deducted from these 7,200, and 1,200 is left. So you understand. So it's important for you to read some of these cases carefully. But as you can see, they're giving us tables, and that's the goodness of this textbook in particular, and the reason why an instructor like me is very fond of this textbook is that it gives you practical examples for you to work out. All right. So, but something like the FIFO methods, remember what is being asked to you is the FIFO method on a perpetual inventory system. A perpetual inventory system, as you understand by the term, by the name itself, says that it is perpetual. It's all the time, right? Which is different from a periodical inventory system. The periodic. So the perpetual inventory system and the periodical inventory system, you will understand that the periodical is a period, perpetual is all the time. So the stock take on a periodical is being taken at a particular period, but the perpetual is happening all the time. I hope that that's you would get some companies, for instance, they do have quite a good IT infrastructure, and they're able to track items, especially items that are barcoded. They're able to track them at all the time. They're able to track them all the time, and that is easy to have a perpetual inventory system. But those that do not have such kind of IT infrastructure, for instance, will do the stock take at after a particular period. Let's say maybe at the end of a particular month, then they will take a stock take. And I think that that's what is happening um, uh, uh, in most of the small businesses like spaza shops and all these kind of things. Okay, so you know that's quite clear. So right, as you can see, there is in and out, in and out. But I think this table for the first in and first out is well done because they show you what is being purchased. You have the date, and I think if you have a question like this, I think you should look at how this is being calculated. The others are quite simple because as you can see, 5,000 at a particular price of 2.5. How did they get the 2.5? Here it said that after marking these goods up with 20% on cost, after marking them up. So there is a markup, and a markup, I wanted to show you how to calculate this because the markup, the cost is of 100%. The markup is always above 100%. So if there is a 20% markup, it means that you have to look at the price. The price is at 120%. It means that the cost is 100%, and we mark up, we add to that 100% cost, we add 20%. So they're saying that the price was set after a markup of 20%. So 3 rands is equal to 120% because they added a markup of 20% to the 100% of cost. So what is now the cost itself? When you want to find the cost, then you will divide 3 divided by 120% or 3 divided by 1.2. That's how you find this cost, this first cost. Because if you try to find out how you get this first cost, you might have a hard time if you're not understanding the principle of markup. So marking up the cost of goods and how you calculate that. The rest is pretty simple because they give you the purchase the purchase cost here. The cost is here. For instance, we have the 2000 was bought at 2.75. So that is provided to you, and it's quite easy. What you need to understand is here is when, for instance, there is this sale of 6,000 that happened on the 8th between the 2nd and the 3rd. So we have the 7,000 that we spoke about. 5,200 will be at a cost of 2. Remember, it's first in, first out. So when we are selling, we're gonna sell first this 5,200 that was at the cost of 2.5. That's the one we're gonna sell first. When we finish selling, then we will sell from the 2000, remember 5,000, or what we sold was 6,000, right? So we take 5,000 from what came in first. What came in first was the 5,200, all of that. To reach 6,000, obviously, we're going to need to add 800. So, but 800 will be at a different cost because the 2,000 that we have there are at a cost of 2.75, and remaining is 1,200 at the cost of 2.75. But then there is an addition of 1,000 at a cost of 2.85, and the 4,000 at a cost of 2.63. And there is a sale, right? Another sale occur because 5,100 units were sold on the 24th, right? So everything that came in first, this one will go first, this one will go first, and this one will go first. Will go after. So the first one will go first, the second one will go second, and the third one. So as you can see, the first one will be sold, second one will be sold entirely, but from the 4,000, only 2,900 is needed to make the 5,000 100. Okay, and the remaining amount will remain at the last. Remember, we took from this 4,000 at that price of 2.63, and so what is remaining, the 1,100, it's remaining at the 2.63. Right. So okay, this is pretty simple, and I expect all of you to be able to understand this, but now we want to value, because the question was value of the closing inventory. So we can see what is the closing inventory here. We know that there will be a 1,100 at a cost of 2.63, and the last purchase that was made for 1,500 units at a cost of 2.87. All right, so these two are what's remaining, and therefore we can find the value of the closing inventory. And the sales revenue, how do we get the sales revenue? It's pretty simple. As you can see, there is a 6,000 and a 5, because remember we sold, right? Remember we sold 6,000 units and 5,100 units, and we sold them at the exact cost of 5 rand. 5 rand 41 cents. Okay, so this will allow us to get, this is our revenue. So the sales revenue is 6,000 6,051 rand. From there we can get the cost of sales. Remember, cost of sales, what are we looking at? We are looking at the purchases that we made at the different prices. So we know we made the first purchase, we know what the price was. The second purchase of 800, remember the 800, the third purchase, let me just see that we are on the same page here. The third purchase was the 1,200. Yeah, these two form the 2,000 rand that was purchased. The 2,000 units, sorry. The 2,000 unit that was purchased. I don't know why they had to split it up. They had to split it up in two. Perhaps is when they were doing the calculation of the issuing. But as you can see, these two, if you combine them together, is the 2,000, right? So we have the 5,200 plus the 2,000 plus 1,000 and plus the 4,000, but the 4,000, let me see if it's also being split. Do not see an inventory split. Let me just keep track of this, the inventory split. I just want to see quickly what was the closing. Oh, right, the closing was here, and the closing was only 7,000. If you look at the closing valuation, it's here. It's only the 7,000. But when the cost of sales is being done, we it's quite clear what they are trying to do. They are tracking this 6,000, which is divided into 5,200 and 800. And they are also tracking this 5,100 They are tracking it as 1,200. So you need to take into account only this calculation that is in the issue here to find the cost of sales. And it's pretty simple. And we can get the gross profit obviously by taking subtracting the sales from the cost of sales. Easy. But then under this perpetual, what is being asked is for you to find these this valuation under the perpetual inventory system. For the FIFO, first in and first out. First in and first out, it's quite straightforward, and then you have the weighted average cost of sales. And when you're looking at the weighted average cost of sales, same table being put, you have the purchases and you have the issues. The issues and then the balance, right? Same table, but two different way, because now what we're gonna do is we're gonna get a weighted average, and it's being explained to you how they get to the weighted average. Remember that 5,000 at 2.5, okay, plus that 2,000 at 2.5. Now we need now to find the weighted average, and the weighted average is A. This one, A, shows you how you get the weighted average. So basically, we take the 5,000 at 2.5 and the 2,000 at 2.75 divided by the number of units. 5,200 plus 2,000, it is equal 7,200. And this is how you get the weighted average. And that's basically the difference between the two systems, is that here you go more by a weighted average. If you have two costs, you need to get the average of those two costs. All right. And so, for instance, when there is an issue of 6,000, well, that 6,000 will be at the weighted average of 2.75. 2.75 is, if you can see very well, you can see 2.5 and 2.75. 2.57 is like a middle way between the two. It's like middle way between the two. But you're not just taking this plus this divided by 2. You're not doing that. You must take into account the quantity. How many were bought at this price, which is 5,200, plus how many were bought, how many units were bought at this price, which is less, 2,000 units were bought at this price, and the 2 will be divided by the total. Sorry, this is 5,200, right? 5,200, right? So the total is 7,200. So that's how you get these weighted costs. So I hope that you can work out how these numbers are being calculated. Should you have an issue and there is maybe a particular place where you are not understanding, then please let's book a session, the two of us. But periodic inventory system, obviously we have just come, what these tables that you saw here, these tables have been used for the perpetual inventory system. So we have first in, first out, which is valuation method. So we are making a difference between the systems and the methods. So within the perpetual system, we use both the first in and first out and the weighted average cost. And in the perpetual, periodic inventory system, which we will see now, we're gonna use also FIFO methods and weighted average methods, right? So as you can see, it's also the same thing, but the table is different that is being used. You can see there is the date, but now we're looking at the number, we're looking at the unit price, and we're looking at the total value. Remember that 5,000 again, we still have it because it's the same example, and that's good. What is good about this book is that you can see the differences between the different methods and systems and what is happening. All right, so obviously we know that the opening inventory, the number of units available for sale, we take the opening inventory plus the purchases, right? The opening inventory was 5,200 and it was at this price, right? 2.5, okay? So the total of that is 13,000, okay? And then there was another 2,000 that was purchased at a price of 2.75, and the total of that is 5,500. Okay, the same as for the other dates, all the purchases that were made, okay, at a different cost, we calculate the total value. And if you can see here, we have now the total number of units and the total value. This is quite important in the periodic, all right? And we do the same. Now, this was for the cost, the valuing of the closing inventory. But if you go down to the sales, remember in the perpetual, because those things are being tracked at the same time, what is coming in and what is coming out, they're being tracked at the same times. That's why we're putting it in the same table. But within the periodic, we are not tracking all of them at the same time. That's why we prefer to track the costs separately from the sales. And the sales, as you can see on the 8th and the 24th, it's that 6,000 and that 5,100 at the same unit price, right? And we have the total. This total is the same whether the total of the revenue will be the same whether it's a periodic inventory system or a perpetual inventory system. You will get the same revenue. What is different is the cost. The cost is different, and that will be the difference. And as you can see here, the unit in closing inventory is 13,000 minus what we in total there was 13,700 in closing, but we know that 11,100 was sold. So the closing inventory in units is 2,600, right? So the problem is not that. The problem is how do we now, what cost do we use? Because it's FIFO, first in, first out. So we need to find for this 2,600, which is 1,500 plus 1,100. Where the 1,100 coming from, and where is the 1,500 coming from? If you see the last of all was 1,500. That was the last one. So the last one uses the last rate. Okay, so these 2,600, this 2,600 is the closing. And so in order for us to evaluate that, we need to find at what cost was the last batch bought. And we can use all the 1,500 because that was the last batch that was bought, at 2.87. It says there, as you can see. I'm making it quite easier. These are the two. This is the last batch. But obviously, we're not getting to 2,600. That's why we need to minus the 2,600, minusing the 1,500 to find 1,100. That will come at a cost, will come from the batch before the last batch, which was a batch of 4,000 that was bought at this price. You understand now where these costs are coming from. All right, so this was the question because we want to find the value of the closing inventory. So we know how many units is the closing inventory is 2,600, and we know what is actually the value of it in terms of rand, how much rand we are talking about. So, and this is quite a good formula as well, because when you look at the cost of sale, how you can now find the cost of sale within the perpetual, you take the opening. Remember, these formulas were at the very beginning of the chapter, where we were looking at the opening inventory, which is 13,000 in value, the opening inventory. The closing inventory, we know it now, it's 7,198, right? Remember? So we have the opening plus purchases minus less closing inventory will give us the cost of sale, which we're going to use to calculate the gross profit. So we know the opening, we know the closing. We just want to find now, where is this 23,000 came from? That's where we have to go out to our table. Remember, there was a 2,000, 1,000, and 4,000. But we're not going to use the entire 4,000, are we? Because remember, from the 4,000, we took 1,100. So 4,000 minus 1,100, 4,000 minus 1,100 give you this 2,900. Okay, so the rest becomes easy, right? Because we have an opening plus 2,000, 1,000, remember? 2,000, 1,000, and then the 4,000, we are only using 2,900 of it, right? So the cost of sale, 11,100 units sold, and this is the value. We take the unit, and one will ask me, why this 11,100? Because the 11,000 is the actual thing that interests us. Because remember, we want to find the cost of sales. We want to find the cost of sales. What was the sales? How many units were sold? 11,100. So we want to find the cost of that sale, of those sales. Sorry. We want to find the cost of those cells, and that's why we have to find 11,100 units. We will start by the 5,200 unit plus the 2,000 plus the 1,000 and only 2,900 to give us the total, yeah. And that's how we'll find. But the weighted average obviously will be different. This was the FIFO, first in, first out method that we were using, but now we are using the weighted average cost method. As you know, we need to find averages. So the average value of inventory available for sale, we take the total value 3,600 divided by the 1,000. This is very important. Remember these two? This is where they are used. Because we want to get the average, we take the total value divided by the total number of units. And this gives us an average. So we know now, under the periodic, the average is 2.64. Okay? Units in closing inventory were 2,600. So we can get the value then. We will get the value then because we know it is this 2,000, the same 2,000 that we use here. Remember, it's this 2,000 because we're looking at the total minus what was sold. That's the closing. The total minus what was sold. 11,100 was sold, right? So, and pretty easy. The sales revenue always stays the same. And the cost of sales for those 11,100 units will be at the average cost. And like I said, the total revenue stays the same. It's only the cost here. Depending on the methods and the inventory system. So you have to combine the method as well as the inventory system. All right, so that was as easy as it is. So that's why I wanted to talk about this. Make sure that you understand how to make the difference between these two, and the questions that will come to you will always try to make sure to test your ability to understand the difference between the inventory method, the valuing method that is being used for the inventory, and the actual system. Are they using a perpetual system or a periodic system? Are they using are you using a first in first out method or a weighted average cost method? So the real cost of inventory, we have the purchasing cost. So when we're looking at the different costs, you have, for instance, the categories of costs for trading inventory. Remember, before we were talking about manufacturing as opposed to trading, but now when we talk, for instance, about trading inventories, you have the purchasing cost, obviously. But that purchasing cost, it's not only the cost of the goods that have been purchased, but you also need to think about the cost of freight, carriage, railage, and or any other means of transportation. All right. So, and this is quite important for you as an entrepreneur, is that you need to understand exactly, because the greatest secret in business is to understand where exactly you need to price. What price do you need to use for your particular items? And so cost, it's not just the cost of goods that you've bought. Everybody could limit themselves there, but you as an entrepreneur should go further to understand that there needs to be taken into account the transportation of that product and all the costs involved to make that product available. Okay, now we come to a very important part, because this ordering cost is going to stick with you until the end of this chapter. The ordering cost, or the acquisition cost, basically speaks about the costs that are needed to prepare, to issue, to pay for a purchase order. So if we want to make a purchase order, what are the costs involved for us to prepare, to issue that order, and to pay for that order, and to receive that order, and to inspect the item included in the order? Because we need to also know that the inspector who will come to inspect if the item is the right, if it's the correct item, and if it's meeting the standards, if it's meeting the standards, all those things involve somehow a cost. Those processes involve cost. You need to know that. Okay, so you have, for instance, stock out cost. Stock out cost, these costs occur when a company's run out of a particular item. We've already mentioned that. So there is a demand of a particular item that we run out. But beyond that, there is other things also as well in that is implicating. There is expediting cost, for instance. If we are running out of that item, how much is it going to cost us to expedite an order of supply? And what will be the transportation cost? And what will be the opportunity cost? And what will be the loss in future sales? Because when we run out of cost of a product, it's going to impact our customers. It's going to impact our reputation. But you see, so this chapter helps you to think much deeper about cost. Quality cost, obviously, like I was saying, these costs need to be determined against a standard or a benchmark. So when we are not meeting the standard and the benchmark, there are costs that will result. And there are 4 identifiable categories of these quality costs, which will be prevention costs, appraisal cost, internal failure, and external failure cost. You can read the definition. But this is the whole point here, was just to come to the calculation. And we have something called the economic order quantity. And this is quite important because it helps us to know there is 2 things that are involved there. There is the ordering and the carrying. There is the acquisition of something, and when we have acquired that inventory, we need to hold it, to keep it. But by holding it or keeping it, there are also costs involved. Okay, so but we need to find what is the right inventory level, and that's where the economic ordering quantity model comes in. Because then the question will be, but what is it going to help us with? It's going to help us to minimize the ordering and the holding of cost. So as you can see, I have made a lot of notes in and around making sure to tell you exactly what is important, what you should understand. But to make it simple is that we need stock because we have a particular demand, but we can't just be holding stocks for the sake of holding stocks. We need to find a level, an ideal level where we are minimizing the ordering cost and the holding costs. So that is quite important. And remember again, the ordering is the acquisition part, the holding as it is ordering, holding, ordering, holding. Holding is the storage part or the cost of carrying that particular inventory. And according to the economic ordering quantity model, these 2 need to equal it themselves to find somehow the right inventory level. The cost of ordering needs to equal the cost of carrying. So and obviously this particular model has assumptions, and they need to be quite a lot of constants. There need to be a constant demand, constant ordering cost, no quantity discount, cost per unit need to be constant, delivery time need to be constant. So you get the picture. It means that for these particular concepts to apply or to work, there needs to be some um, uh, uh, um, assumptions that are being said, or in other words, there need to be some terms and conditions. There need to be a particular setting fitting for this to work. All right, so it's almost like it's in a particular lab, but it needs to work. So ordering and holding cost, I want you to remember that ordering and holding cost. Okay, ordering and holding cost, they are quite important, and you will have some examples in it. And if you remember very well, we touch on this formula here. We touch on it. Average quantity in inventory, where we say that the quantity, the size of the order divided by 2 plus this, the safety. Remember, it's at the very beginning of the chapter. We were talking and mentioning this. So these formulas are quite important, but let me caution you again. For instance, here, as you can see here, you have the order size, you have the number of orders, you have the ordering cost, average inventory, holding inventory, and total annual cost. And obviously this table is to show you, for instance, that where exactly we have the minimum cost, minimum total annual cost. And this is the formula in question itself that helps us find that cost. 2 is a constant. D is the annual demand or requirement. What is the demands of a particular product? O is the cost of order. H is the annual holding cost per unit. Remember, the cost is per order. Order. Remember that an order can have a size. We can have a demand of 10,000 for the year. That's the demand of our products, okay? But when we order in batches of 5,000. So 5,000 is the order size, all right? 5,000 is the order size, and when you look here, there is even an average inventory, which is the order size divided by 2. All right, so we have the interest. There is somehow also an interest that could be implicated, but sometimes it's not included, and the cost per unit, and the cost per unit. Cost per unit multiplied by you might get a cost per unit in a particular problem. You might get the cost per unit, but you are not getting the interest. So you would assume that the interest is 0. And that's why here, as you can see, for this particular example, this 6 is only the annual holding cost per unit. That's what it is. So there is the demand on top, 2 times the demand on top, plus the cost per order. Not the order size, but the cost per order. And the cost per order in this example is 450. So this is quite a very interesting topic that I will leave you to read, and will provide some of these notes. Hopefully that you find them useful, and I cannot wait to engage with you on this chapter. So should you have questions, as you can see, in one session we cannot cover it all. It will require you to do some readings, but should you struggle with a particular concept that you are not understanding, you are more than welcome to reach out to me. All right, so as it is again, ladies and gents, so that's it for our session. I prefer to close shop now. and I'm waiting to hear from you. Remember, we will have our next session that will be on assignments 2. We will do a national session on the assignments 2, and hoping to have all of you do very well for your assignments 2, and that will make you at an advantage when it comes to the final uh, the final exam. All right, so waiting to hear from you.